Hello, and welcome to the Trade Finance Distribution Initiative podcast, the business community for standard setting stakeholders within the trade finance distribution space. Delighted to have you here again. My name is Doris Kunanovich, and today we're throwing the spotlight on a leading European credit manager that provides a range of financing solutions for borrowers as well as investment solutions for institutional investors. I'm talking about Pemberton. Our guest today is Mark Hickey. He's a partner and head of working capital finance at Pemberton. Mark, it's really lovely to have you here today.
Thanks, Doris. It's great to be here.
Mark, now I probably couldn't have a better person within Pemberton to discuss the business's role in trade finance, as you yourself have been investing in over 10 billion US dollars in corporate credit. Can you tell us a little bit about your journey within Pemberton?
Sure. Well, we set up Pemberton. I was one of the three founding partners that set up Pemberton about 8 or 9 years ago. Pemberton is an independent asset management business. It's focused on private credit strategies. And today we have $16 billion of committed capital from about 170 institutional investors and employ about 150 people in the firm. But I guess going back to when we set up the firm, we felt that there was going to be a long-term imbalance between supply and demand for corporate credit, particularly in the European market, in the years following the global financial crisis. We felt that that corporate credit market, which has historically been very dominated by banks, that they would not always be able to meet the demand for credit in certain segments of the market due to certain constraints, regulatory, capital constraints, and so forth. On the other hand, we felt that in the institutional market, people would be very keen to look at private markets in a search for yield in a low interest rate environment. So we felt that that private credit sector would be very interesting for those investors, in particular because there's complexity in private assets, and a lot of institutions would need to work with third-party asset managers in order to access the investment opportunities in that private credit space. This is why we set up Pemberton initially. We picked direct lending, what we call direct lending, as our launch strategy. What in the banking industry might be known as mid-market leverage finance. And over the last 7 or 8 years that we've been investing, that market has really grown very significantly, and asset managers have come to dominate in that direct lending space. And Pemberton has established itself as one of the largest managers in the space. So as we've grown our firm and we've continued to build out the AUM, we have also started some new strategies. We have 7 strategies in total now, 3 of which are direct lending, and 1 of which is the working capital finance strategy that I'm responsible for. So I was the lead portfolio manager for our main direct lending strategy for 7 years from inception, when we started investing money back in 2014, until I switched to run our new working capital finance strategy last year.
Amazing. And why trade finance? I mean, you could have been in any other space. Are you active in other asset classes, and what was the attraction to trade finance?
Yeah, but I mean, if you look at our AUM today, which is just said is $16 billion, over 90% of that is in the direct lending strategies. So when we were looking at if you like a second area through which to develop a strategy to offer our clients, what we saw in trade finance, or as we call it, working capital finance, is even more broad an area. This is a market size in trillions of dollars globally, but there was really still very dominated almost exclusively by bank financing. And we felt that in the same way that institutional capital has had a strong role to play in the corporate lending market, particularly in the direct lending areas that we operate in the last few years, we felt that there'd be a big role for institutional capital to play over the next 5 or 10 years, also in the sort of short duration corporate credit market, in this working capital finance market. So we felt that we had the ability with our platform to offer an interesting strategy to investors. We felt that we're genuinely providing, adding economic value to corporate clients in that area as well, and that we can build a scale business. So those are really the reasons that we decided to build a strategy in this area.
And you touched on the banks being traditionally within this space, and it being a space for credit insurers and bankers. Now, what do you think has changed in the market now today to attract new liquidity providers such as yourselves?
Well, I guess there'd be 2 main reasons. I think that certainly from our perspective, developments in technology in the last 10 or 20 years have given us the tools to be able to monitor the risk, which historically banks have developed their own platforms, which are really only very large institutions had those platforms. Now there's as I know you're very familiar with, a lot of different technology platforms that can provide tools that enable us to sort of monitor exactly where the risk positions that we have every day. We're receiving repayments of thousands of invoices every day, making new advances against new assets every day, and we know in real time exactly where each of these assets are due to technology. So first of all, it's developments in technology that give us the ability to monitor the risk. But I also think that as the bank market has evolved over the last 10 years in particular, the banks obviously continue to dominate this market and will continue to be the major provider of financing in this space. But there are some segments of the market where, for different reasons, the banks, we think, sort of serve those segments less well. Banks under certain regulatory or risk constraints, and we can be good partners for banks in that space and provide solutions for our underlying corporate clients as well. So it's really, I guess, evolution in the bank market and also developments in technology.
That's great. And let's talk about the DNA of these clients that you're talking about. What sort of originators are you interested in providing liquidity to?
Well, we are. We're sourcing assets through a number of different channels. So, as I mentioned, we're working with a number of banks. We have good contacts across the banking industry to source assets. We also work with technology platforms themselves, an increasingly important source of assets for us. But probably the most important source of assets right now is directly through the corporate channel. So talking through our own network and to our corporate clients, and also to companies that are introduced to us, working with several intermediaries that we work with, in particular, our clients in the private equity space that we have through our direct lending business. So the borrowers that we're funding are mid or large cap corporates, and we're not funding non-bank lending platforms. We're not funding factoring companies. We're funding directly to corporates in every case, but we're sourcing those investment opportunities through, as I mentioned, those different channels.
And what are those instruments that you're funding particularly?
We have a pretty flexible investment strategy that can fund a variety of different products. So for us, working capital finance comprises exactly that, the different components of working capital, which is receivables, payables, and inventory. And we have a strategy that it can invest in a number of different products in product structures in each of those different asset classes.
All right. If you're just joining us, this is the TFD Initiative podcast, where we have the Pemberton partner and head of working capital finance, Mark Hickey. Mark, we're still talking about funding. Who are the investors in your funds?
Well, if you look at Pemberton as a whole, our $16 billion of committed capital is quite an institutional client base. So it's predominantly insurance groups and pension funds. That comprises about 90% of our AUM. The other 10% would be predominantly from family offices. And if you look at the working capital finance strategy, it's a similar mix of investors as well. So Pemberton was conceived, as I mentioned, as a platform to offer investment strategies in private credit to the institutional market. And as we have evolved over the last 7 or 8 years, we've managed to win the trust of 30 to 40 different insurance groups and a similar number of large pension funds, including some of the largest insurance groups and pension funds in Europe. As we're developing now, increasingly our investor base is becoming sort of heavier weighted towards the North American market and also in Asia. But currently, European institutions still provide the lion's share of our capital.
And when you're working with your clients, how do you underwrite credit risk?
Well, Pemberton's built its reputation on fundamental credit analysis. This is how the cornerstone in which we've really built our business. So we have a large investment team of about 60 people. It's very experienced professionals in credit risk analysis, lending, and very strong team of senior people. So the process that we have is actually quite bank-like, I would say, and quite different to how traditional asset managers would approach investments. And one reason for that is because we're investing in private assets. And as I mentioned earlier, private assets, there's often a degree of complexity, and we want a very robust investment process that provides a maximum challenge to the judgments of the team before an investment is approved. So we have a committee decision-making structure rather than giving discretion to the portfolio managers. But the key sort of aspect to our process that may be different to how other asset managers approach this, we have this kind of dual track process that we refer to, where we have our origination and portfolio management teams on one track, analyzing an investment opportunity, and a separate independent credit team, which is, we have about 20 credit analysts internally who look at each potential investment opportunity, and both of those teams write papers which the committee then considers when it makes the investment decision. So it's a very work-intensive, people-intensive fundamental credit underwriting, but this is, I guess, the part of the main added value that we're offering our investors.
And are you relying on credit insurance yourself?
Well, we do work with a number of credit insurers. In our working capital finance strategy, we have both insured and uninsured share classes that people can invest in, and so we find that a number of investors like the additional comfort of having credit insurance on the assets that we're investing in. So we work closely with a number of the leading credit insurers as well. And this is a market that as you know very well, has been dominated by banks and credit insurers over the years. We don't see ourselves in competition to those organizations at all. We see ourselves as partners to the banks, where banks may have be capped out on risk concentration, or from time to time may have balance sheet constraints. We can work with them to support their clients in a way that they're not able to. And similarly with credit insurers, we're becoming increasingly important customers of the credit insurers as we build up the size of our portfolio. So that's another very important constituency for us.
Now, earlier on, you touched on the use of technology within this space, and I suppose a lot of asset management teams are looking into the use of technology for digitization and easing workflow. And as such, within the space of risk scoring transactions, are you using any technologies? How are you currently risk scoring?
Yeah, so also the risk scoring on the risk scoring front first, we actually have our own rating model. This is a model that was actually originally developed by one of the leading German banks and was approved by the BaFin for regulatory capital reporting on advanced IRB. So it's got a long track record of being an accurate predictor of probability of default, and this is a tool that we invested in really to provide transparency to our investor base, because one of the challenges with private credit assets, obviously, is it's not easy to see from the outside what risks the manager is taking and what risks you have in the portfolio. So we don't really use it as part of the investment process to underwrite the risk, but we think it's a valuable tool to sort of give transparency. The investors know that if a certain asset is a double B rated asset or a single B rated asset, triple B rated asset, then they can see that through the rating. In terms of technology itself, and we have made pretty big investments in technology over the last couple of years as we've been building out the strategy. So in our view, that in order to succeed in this business, you really need three key building blocks. The first is the team, and I didn't mention the team we have here, but we've hired 8 people that have more than 15 years experience in this asset class specifically. We don't think any other non-bank investor in the asset class has made that kind of investment in people. So that's the first thing, is we have a very experienced team of people here who've been used to sourcing and structuring and underwriting risk in this area over a long period of time. The second, in terms of the technology, is that we have a development team here internally that works with the external technology partners that we work with to service our assets, and we put quite a lot of resource into building our own technology platform to interface with those external providers, and also make sure that we have the ability to track, as I mentioned earlier, in real time our risk positions and payments in and out across the portfolio. And we're going to continue to invest in that as we go forwards and build the business.
And I'm going to pick your brains on what you think the role of technology should be in today's investment, trade finance investment market.
Well, I think that in order to enable the market to develop, especially in terms of distribution, increasing standardization is very important, and data is very important. And so technology obviously is at the center of that, and we see that with the investments that we've made as well, and we're really excited about it, because what technology can do is really make the business even more scalable, and that's ultimately to the benefit of all the participants in the market. So we're keen to work with the 5 or 6 technology companies that service our assets and work closely with them going forwards and play an active role in working out how we can work better together as we continue to grow the business.
Now, you've been in this business for a lot of years and you've seen the changes that have happened from traditional banks moving now to trade finance assets and trade finance managers. What major technology developments have you witnessed within trade distribution?
I think that one of the big changes has been, if you go back 10 or 15 years, a lot of the banks had their own proprietary systems, and now increasingly they're moving to the third-party service providers as well. And I think that which makes sense because those companies have spent tens of millions developing their own systems in state of the art, and the banks can get much more efficiency from working with third-party providers. But that also means that that new entrants to the market, if you like us, in the last few years, we're able to use the same technology platforms as the major banks. So in a sense, that gives us an easy way to enter the industry and benefit from the same technology platforms that even the biggest banks are using.
Right. And do you have any final predictions in terms of how maybe technology would be used within this space in the next, say, 3 to 5 years?
I think, maybe, I'm sorry to disappoint you, I'm not sure there's going to be any massive revolution beyond what's already happening. I think that as I mentioned, all of the participants that we talk to are keen to continue using technology to improve their processes and improve efficiency. I think that you're just going to see continued adoption of technology to facilitate lending, to facilitate financing, and I think that you'll see people, institutions like Pemberton continue to invest in technology to help us scale the business.
Amazing. And the key phrase there is continued adoption. So it's something that we're all looking forward to. It's an exciting future ahead. Well, I'm afraid that's all the time we've got today. Thank you so much for speaking with us, Mark.
It's been my pleasure, and great to join you on this podcast.
Thank you. All right, to stay in the loop of all our podcast episodes, do subscribe to our channel on Spotify. That's the Trade Finance Distribution Initiative podcast, and to our YouTube page where you can watch all the videos in podcast form. Thanks for being here. I'm Doris Kunanovich. Enjoy your day.